Good morning, everyone. It is time for Smart Money with Stephanie. And when people can start talking about money in a positive way, I think ears perk up just a little bit, Jackie.
Absolutely. Helping you out this morning with your finances. Who doesn't love to hear that? So Stephanie Bowles joining us from SA3 Wealth. Thank you so much for being here. All right, let's talk about the market a little bit this morning. Things people don't realize, or the volatility that maybe some people are feeling right now.
Yeah, the volatility has been quite high this year. It seems like every time we take 2 steps forward, you're taking 2 steps back. So there's some tips that people can use to try to weather through some of those things you should do, things you shouldn't do. So we'll talk a little bit about that.
Yeah, beginning of the year, for example, we were just talking a couple seconds ago, beginning of the year, we're riding the crest, and all of a sudden the roller coaster was going down.
Yeah. So there's not a lot of new news this year. It's just we're further along in the business cycle. We're getting closer and closer towards normal market changes. We're not always going to have 20-30% returns every year. We do tend to have some up years and some down years. We haven't seen some down years in quite a long time. So when we do start to see some volatility, people forget that that's normal. And so there's some important things. There's some tips that people can use to try to take advantage of the market changes. 1, don't try to time the market, and 2, try to tune out some of the noise that's out there. People will try to go in and out when they think the markets are doing well. They'll try to get in.
Right.
And when they think that the markets are going to go down, or they already have gone down, they'll try to get out.
Okay, so that's what you mean by don't market time. Don't try to time your strategic planning based on what you think is happening.
So there isn't something to buying low and selling high, or
there is. There is, and actually one of the strategies to do that with is a concept called dollar cost averaging. So what you do with dollar cost averaging is you're putting in a fixed amount of money every single investment time frame. So we all do it now with our 401ks and our retirement plans.
Okay, sure.
You've got a fixed amount coming through in every payroll.
Right.
When the markets go up, you're going to buy a little bit less shares, but when the markets go down, you're going to buy more shares. So when you're a long-term saver, think about it when you go to the grocery store. Where do you want your price to be when you're trying to load up on some groceries? You want the prices to be low.
Right.
Nobody goes to the grocery store and said, oh, that price is too low, I'm going to wait till it goes up to buy it. But we do that with stocks all the time because our mentality is we want to buy that momentum. But if you're a long-term investor, really buying the markets on sale could be advantageous in the long run.
And by having that consistent amount that you're investing, just by chance if it goes down, you are just going to get more as a byproduct of that. Right.
And it's not a proven strategy. A lot of it will depend on your time frame too. So the longer time frame you have, the better market averages you're going to have by dollar cost averaging. So that'll be a good strategy to try to weather through the market volatility and not try to time to get in and get out. Another good strategy is to make sure that you have the proper risk tolerance for your comfort level and your time zone. Somebody who's 20 years old should have a very different strategy for saving than somebody who is 60 years old.
And what are those strategies? What would you say? Let's say a 20-year-old comes in and they have a full-time job and they say, I'm going to start investing. What do you want them to do? Right.
So you've got 2 things that we're looking at with a 20-year-old. One is they really just need their money to grow. So we're looking at stuff that's really long-term for most of those people, especially if they're looking to plan for retirement. We can look at some strategies that are very long-term. So they might be looking at some growth-type strategies. Somebody who's closer to retirement may be looking at some strategies. They've already built up some of those portfolios, are looking more to conserve it, start drawing some income on it. So turning those portfolioes into an income stream. We've already done the accumulation on those portfolios.
So would you be more aggressive for the 20-year-olds in trying to make bigger gains at the beginning?
Depending on their investment experience, for the most part, most younger people are going to be more growth-oriented, more aggressive. They can weather more volatility in the markets because psychologically, if you have a 10% correction on a $1,000 account, 10% doesn't seem quite so much as when it's a $100,000 account. 10%, it's still 10%. But psychologically, that number feels very different when you look at that statement.
Absolutely. Okay, so what are some steps besides just saying we need to be investing if we want to watch any kind of money grow or move, but what would be some steps if you're wanting to get started?
So first things you want to do to get started is find out what your risk tolerance is. We do risk tolerance questionnaires with all of our clients. We look at their time frame and their goals, and a lot of times clients have different strategies, so we set up different investments for those goals. Short-term, mid-term, long-term goals are all going to have different strategies.
Okay.
And then we also take a look at the investment experience that somebody has to set up a strategy. You know, there are some simple things you can do. You could dollar cost average into a mutual fund for as little as $50 a month for somebody just looking to get started. So
really, and that does add up over time.
it does, especially you know, for a younger person. And then for those people who are on the flip side of that, looking to retire soon, we actually can do the reverse strategy and help them dollar cost average into more conservative investments as they're getting closer to retirement.
How close to retirement can somebody still, you know, take advantage of your services and have a big dividend payout?
Well, your retirement doesn't end just the day you retire. Your retirement could be for 30 years, so you're still going to have some money that's going to be.
That's a good way of looking at it, yeah.
Just because you've entered in retirement, nobody cashes out all of their investments the day they retire. It still has to last. It still has to outperform inflation for potentially a 30-year retirement. So we have different buckets and strategies that we use for people who are retiring. Money we're going to spend in the first 1 to 3 years, 3 to 5, 5 to 7, and then 10 years or more. We might have a similar strategy to somebody who's in their 20s and 30s, because that's not going to be money that's touched for the next 10 years or so.
Now, when it comes to investing and the different strategies that you have, of course, you have some of your stocks that are more aggressive than others. Do you want your clients to give you suggestions? Hey, you want to keep a look at this or take a look at this for individual companies, or do you guys have your companies already grouped together?
We have clients who do have custom portfolios, and then we also have some models that we've created where clients, we have an investment committee that works together once a month, and we look at portfolios, and we have clients who are just in that particular portfolio. But we do have clients who want some more customization, whether it's straight stocks. A lot of clients use mutual funds. A lot of clients use income-producing securities. So it's not just straight stocks.
And how often should someone be looking at that portfolio and just checking in to make sure everything's how they want it to be?
I would say at minimum your portfolio should get reviewed and potentially even rebalanced at least once a year.
Okay.
Once a year, kind of get that checkup and see what's going on.
Yep, a lot of our clients do come in quarterly, but I would say at minimum at least once a year.
So it's not out of the question to every couple of months, you know, sit down and just check out and see how your investments are doing. And you can you make adjustments quarterly, or do you have to wait to the beginning of the year?
No, you can make adjustments. You could make adjustments daily. I don't recommend doing that, but you could. And you don't need to watch your portfolio on a daily basis, especially where we're at in the market cycle now. That would
probably drive you crazy, wouldn't it? Yeah.
And if you wanted to, I mean, you could. There's so much information out there. You could literally be watching something 24/7 and just. What does that do to a person? Because you kind of mentioned don't get caught up in all of that.
And I always tell people tune out the noise. We have 24/7 access to investment news today, and a lot of the news that's coming out today is focusing on short-term investing, when most of us are long-term savers.
Right.
So what you're seeing on the news every day doesn't necessarily apply to a long-term investor. It's a trader or somebody who's getting in and out of the markets and how it's impacting them right now.
Right.
That doesn't apply to most people. Most people are long-term savers in 401ks, college plans, those types of things.
Right. Well, it sounds like the best idea is to take your money like this and say, okay, here you go, SA3 Wealth. I'll look at it. I'll look at it in a year and I'll be happy.
I was going to say, you're breaking it down in a very easy way for us this morning, but it's nice when there's experts out there that can guide you and say, we already have plans in place depending on what your future is for you, specifically your age, your volatility, and what the kind of tolerance that you're looking for. So, but you mentioned that $50 could be the easiest and simplest way that I could hand over to you and you can do something with. Can you break that down for me a little bit, how we can get that started?
Yep, so a client would just come in for a free review. We do a risk tolerance questionnaire, kind of set some goals, and we start working, set up an account so that they can save as little as $50 a month towards whether it be saving for a car, college, retirement, emergency funds. And it's pretty simple to do. An hour, that's all it takes.
I think the key thing is just get started.
It is. That is the hardest part. Get that momentum going.
And I love the idea that $50 could get things really changed in your life, and you could be using your money in a smarter way for you.
Right.
Wonderful. Okay, so how can we get started with that meeting that you're going to give us?
Yep, so next steps would be to contact our office at SA3 Wealth. Our website's a good resource. You can go to sa3wealth.com. It's got all of our contact information there. And we can schedule a free review.
That works.
Love it.
Thank you so much for being here.
Thank you.
All right, don't go too far. It is 7:38 right now, and we shall return.